All right. Good morning, everybody. Thank you again for joining ATBS in our annual independent contractor benchmarking webinar. We've done this for a lot of years in a row now, and it's always a good time to kind of take a look at what happened during the previous year with owner operators and their operating numbers and kind of talk about what we think, 2018 holds for them. So we're going to go through, as usual, a ton of data and information today. I have a tendency to talk really quickly. I apologize for that, but I have a bunch of stuff to go through. The good news is we'll record this webinar, and so we'll get you a recording afterwards. If you miss anything or you want to see some of the data more specifically on the slides, we'll get you a recording afterwards. Also, remember that you can type questions if you don't understand or you have a question on something that we're talking about. You can type questions in the bottom right hand of the GoToWebinar, and we'll answer those questions at the end for you. And so, with that, I'm going to get started. My name's Todd Amon, and I'm the president and CEO of ATBS. We appreciate all of you that are on the line. The majority of the folks on the line are partners of ours through motor carriers or finance companies or insurance companies and folks like that we partner with to help independent contractors to be more successful in their business. So thanks for being here. Hopefully we can share some insightful information with you. And we're all off, I imagine, to a great start when trucking is doing well. All of us on the phone are doing well. And so hopefully you all are feeling great about the start to this year. Just one more thing before I get rolling through the slides. We have started asking poll questions over the last few years about rate increases and fleet growth and those kinds of things. So we will have two or three pauses where we ask you to participate in a poll question. The good news is we can share those instantaneously with you, the results of those questions, and it really helps all of us kind of understand what the industry is thinking. On the phone, we have well over 100,000 owner operators represented with the partnerships of the folks that are on the line from the fleets, and so it really is a pretty good representative sample of what's going on in the industry today as we ask those poll questions. So with that, I'll get started. I'm going to spend just a couple of slides kind of setting the stage for us here. Talk about ATBS and who our clients are. And we started a few years ago really segmenting out. We used to just think of owner operators like everybody as a person with their own truck who drives and hauls freight. And as we all get better and trying to understand the industry better and the drivers, we've started segmenting out drivers. And I'm going to refer to these different categories of drivers through the presentation. So I just want to lay the groundwork for you as we all think about them in their different ways. A pioneer is simply one of those people that are very early in being an owner operator. They typically get their truck through a fleet lease purchase program, probably no money down. They've probably been a company driver for a while and they're just getting out, really for the first time and kind of experiencing becoming an owner operator. The hired gun is that bit more sophisticated owner operator that, probably was a pioneer for a while, saved up some money and actually went out and bought their own truck with some down payment money. And they have the ability to really run as a true owner operator, but they like the safety and the comfort and really all the benefits that are affiliated with being associated with the fleet. So they lease that truck back on to operate for a motor carrier. So that's why we call them hired guns. And then we have lone rangers, and that's that driver who has their own truck, but they, really have taken the step to go out and get their own authority and run their own business out there on their own and collect their own bills and do all those kinds of things. And we're in a market where there's more and more of those lone rangers every day right now, and we'll talk about why that is and how people migrate between these kind of different operating models in the owner operator business. And we've added a new one this year that we're seeing more and more of, at least from the ATBS business perspective, and that's the trailblazer. And that's the person that, has probably been a lone ranger for a few years and they're successful enough in their business. They've built enough customer relationships. They're actually going out and buying additional trucks. They may do that again under a fleet. They may operate and they may like to operate multiple trucks under the fleet. That works really well for them. But there's also a ton of them that go out there and have their own freight relationships. So those are the four categories that we kind of bucket the owner operators into, and I'll be talking more about each of those as we go through the slides. At ATBS, we do a variety of services. We have tailored packages that fit each of those categories. Our essential service is kind of a bare bones. We do the bookkeeping and taxes for that person that's super experienced and doesn't need a lot of help in their business. They just want someone to take all the paperwork away from them and do a really good tax return. Our professional service kind of serves that more owner operator who's fairly new that needs consulting and benchmarking and profit planning and really needs a lot of help with their business. And then in our enterprise service, we help those folks that are pretty sophisticated that have payroll and multiple trucks. We can help them get incorporated and do all those kinds of things. So again, just kind of want to remind you, when we go through all this data, these are the services that we get all the data from those truck drivers for that make up all the benchmark data we're going to be going through. If you were on our Tax Cuts and Job Act webinar early this year, kind of in mid-January, I apologize, this may be a little bit redundant, but it's only going to be about 5 or 10 minutes. There's still a ton of people that are curious and misconception and things that are not understood about the new tax law that went into effect at the end of last year. And so I'm just going to talk about a couple things that specifically affect independent contractors and really how I think they're going to affect the market this year. So we'll run through a couple of those just at a high level. I know you've heard and read and seen, and it's kind of died down in the news. But at the end of the year and the beginning of this year in January, there was all kinds of news stories. This wasn't just a tweak to the tax rates where we raised them or lowered them a percentage, and we might have moved capital gains rates a little bit. This was a huge tax reform. It was over 1,100 pages added to the tax code, and so there was significant change in a lot of areas. And it's a big deal for owner operators for sure, and for industry in general. Our general takeaway as we've done the research is we believe the average owner operator is going to save about $2,000 in taxes, and I'll tell you why that is in a minute. And we also believe the average company driver is going to lose about $600. They're going to pay more in taxes, and that really has to do just with per diem, and I'll talk about that a little bit. The bottom bullet point on this slide is really important, I think, for all of us. Number one, for owner operators, there's huge incentives for them to go out and buy equipment because they can now depreciate that 100% in the year that they buy it and offset their taxes. But beyond that, you have also read and heard stories about Boeing selling more planes than they ever have before, and these multi-billion-dollar orders for assets around the country. And the good news for all of us is that tax incentive and that 100% depreciation is pulling a lot of purchases forward of capital goods. What that means is trucks need to move all that stuff to get built that's being ordered. And so it means a really robust freight environment, which is one of the big reasons we're in such a great, freight environment right now. So I'll talk just for a minute about the qualified business income pass-through entity deduction. This is one of the biggest changes of the tax code, and for owner operators is probably the biggest change in the tax code. And one thing we all heard was the tax law was going to be changed and it's going to simplify the filing process and we'll be able to do it on a postcard. And I can tell you that when you read through a section like this about the qualified business income deduction and the multiple pages that it takes to describe how this works, it did not get simpler. It got much more complicated. But the good news is the complication is going to be a benefit for owner operators. So all this really simply says is that owner operators get an additional deduction on their business, and it's specifically a 20% deduction. In real numbers, what that means is if the average owner operator makes $60,000, they can take an additional 20% deduction off that net income of 60,000. So let's say $12,000 deduction, and it really reduces their net income down to $48,000. So all it's really doing is reducing their taxable net income, which is going to reduce their taxes, and that's where that roughly $2,000 in tax savings comes from that I talked about early on. Probably the most confusing thing about this new law is that there's a lot of folks, and you hear chatter on the radio and everybody that you talk to, that you need to change your structure. You need to become an S corp to take advantage of this. And the thing everybody needs to know crystal clear is that if I'm an independent business owner, if I file a Schedule C that lists out my business income deductions and net income, I'm in fine shape. I don't need to do anything. I don't have to have any corporate structure change to take advantage of this qualified business income deduction. I can be a sole proprietor. I can be a partnership. I can be an LLC. I can be an S corp. So they don't need to freak out and they don't need to go, do a bunch of things to take advantage of this. They will automatically when they do their 2018 tax return. On the flip side, as an industry, as we've all dealt with the issue of employee versus owner operator, over the last 8 or 9 years, and there's been attacks on that model by the government agencies and those kinds of things. We all know that when a truck line does business with an independent contractor that is structured as a business, it's a much more legitimate situation and much more defensible in a lot of those court cases. And so we do believe this is an opportunity for owner operators in our industry for people to look at their structure, and we do believe there's tax advantage to becoming an S corp, and I'll talk through a little bit of that in just a second. From a depreciation perspective, I already mentioned it, but the great news about this is if I buy a truck today or I buy a trailer today, 100% of that truck, trailer, APU, computer, any capital asset I purchase in my business is 100% deductible this year. Used to be I had to do a phased in depreciation over multiple years, and I didn't get to take that completely. At the bottom of this slide, the other good news is the new tax law allows that to be used on used equipment, not just new equipment. And so that's a big deal for owner operators, and they can really offset a huge amount of their net income. And without getting into a ton of detail, this takes some pretty sophisticated tax planning because there's been a lot of tax law change in the deduction amounts, and so we've doubled the standard deduction up to $24,000. And so I actually might be doing myself harm if I depreciate my truck 100% because I then don't get to take advantage of that double standard deduction. So again, I'm not going to get too complex in the tax law, other than to say things have gotten a lot more complicated, and owner operators need to make sure that they're using someone that really understands all these things that affect their business. So everybody on the phone, this next slide, affects all of us. The standard deduction. The good news is it pretty much doubled across the board, whether I file joint with a spouse or I file single or head of household. And so for joint, we went from $12,000 to $24,000, and that's good news. That just means that all those itemized things we used to have to keep track of, like home mortgage interest and medical bills and a lot of that kind of stuff, we don't have to worry about anymore because we're going to fall under that $24,000 limit. We just file the simple standard deduction. We don't need to itemize on Schedule A anymore. So this slide, adds some complexity. There was a ton of change in some of the deductions that people used to itemize on Schedule A, and I won't waste time going through these details because again, probably 95% of, for sure, truck drivers and Americans in general are going to just do the standard deduction now because they're going to fall below that amount. The most important thing is the bottom line on here, and where it talks about unreimbursed employee expenses. That is where Congress, when they passed this law, eliminated the per diem deduction for truck driver employees, not for owner operators. And it's a really important distinction because this is a huge, huge confusing point. I've been on satellite radio on most of the shows, over the last 5 or 6 weeks, and we spend 70% of our time talking about per diem when people call in with questions on satellite radio because they just don't understand it. So the simple thing to understand is that owner operators can still take a per diem deduction because they do that as a business expense and they do it on Schedule C. Company drivers no longer can take that deduction. There's a few things on these slides that I'm just going to go through real quick, simply when we send out the deck to you that you might want to read through in detail. So um, we're going to get to the Affordable Care Act penalty, and a lot of folks heard that as Congress passed this new tax law, that Obamacare was repealed, that it was a sneaky backdoor way to get rid of Obamacare, and we don't have to worry about it anymore. And maybe whether that's true or not, I'm not quite sure. But what I do know is they did eliminate the Obamacare penalty if I don't have Affordable Care Act compliant health insurance. Unfortunately, everybody just hears the penalty got eliminated and they don't hear the details. And so, what owner operators need to know is that got eliminated as of January 1st, 2019. So, if I don't have Affordable Care Act compliant health insurance for 2017, we're in the middle of doing tax returns right now. I'm going to pay the penalty, and I'm also going to pay that penalty in 2018 if I don't have that health insurance in place. And those penalties have gotten pretty significant. They range on the low side from $600 all the way up to $2,000, kind of depending on the formulas and all that kind of stuff. That's the fun things we're calculating right now as we do tax returns. I'm going to touch on tax brackets real quick. And again, this is something for everybody on the phone. Tax brackets in general, unless you're an extremely high net earner or a W-2 wage earner, went down about 3% on average. And so on this slide, we can see the highlighted red is kind of where the average owner operator categories fall. So if I'm a single taxpayer and I make about $60,000 on average, on the first $38,000 of my income, my tax rate went from 15% down to 12%. That's a great thing. And then for my income over 38,000, I went from 25% to 22%. On this slide, we see for those that file with their spouse, a similar situation. They just have a higher income threshold. So if I'm an average owner operator that makes $60,000 and I'm married filing with my spouse, my taxable income bracket went from 15% to 12%. So that's a great thing. So really the takeaways, and you heard a little bit about this, but we're experiencing it right now. Um, the average employee got a paycheck boost starting in February when all the withholding tables were changed. And, hopefully each of you that are employees of the companies that you work for saw a little bit of an increase in your paycheck because your taxes are lower. What that means for the owner operator is when they pay their estimated taxes, which we're, literally in the middle of right now, they're due April 15th, and we're getting ready to send those estimates out to the drivers. We had to redo our entire estimated tax calculation process. It's been about a month of programming, but they're going to be lower as well because taxes are going down on owner operators. So that's a great thing. This slide has a lot of numbers on it, and I just want you to go down and look at the bottom line from the two lines up from the bottom that say single taxpayer liability. What we really tried to do when you get a complex tax change like this, it's almost impossible until they get all the computer programming, software filing that you do tax returns with reprogrammed, which really honestly doesn't even happen until the end of this year. It's really hard to find out unless you put specific scenarios into returns what the true impact is. And so we spent a bunch of time creating Excel spreadsheets around here to, just come up with some generalities of what the tax reform meant for owner operators. And when you look on this slide, kind of in the middle, you see 2018 versus 2017 for sole proprietors. The good news is on that single taxpayer line, the average owner operator, that's where we get our $2,000 in savings. They're going to go from paying about $11,400 a year down to $9,300 a year, a couple $1,000s in savings. You can see the left-hand side, that's where we calculate that the average company driver is going to go up about $600 if they're not getting a per diem pay. And then you can see under the S Corp, when you just look at 2018, the average owner operator is going to pay $6,700 in taxes. And, as I said earlier, I do believe that there's incentive this year. And we're talking to a lot of our clients about the opportunity to become an S Corp rather than just a sole proprietor. Because if you become an S Corp and you make over $60,000, you can pay yourself a wage and save a significant amount of money on self employment taxes. So, again, without going real deep in these numbers, the most efficient tax structure for an owner operator earning a pretty decent amount of money over 60,000, they're going to pay about $6,700 in net income. And it's complicated. I got to set up an S corp, I got to do payroll, I got to do withholding taxes. At ATBS we can do all that for the driver, we can do the corporate tax return, but it costs more money. So in the end, you got to balance. What am I going to save in taxes? Oftentimes, it's $2, 3, $4,000, and it might cost an extra $1,000. So, again, sorry to throw all this tax stuff at you, but I think it's important because we're in a time where a lot of drivers are trying to, figure out what's right for them. So this last slide we did for some partner fleets that ran company drivers and owner operators, and there's many of you on the phone today. And really, all we were trying to do is help people understand why a company should have a per diem pay structure if they have employee drivers. And I know we're here to talk about owner operators, but in a lot of cases we also deal with employee drivers. Even if I'm one of those trailblazers and I've got 3 trucks running for me, I've got to consider this situation. So if you look at the right hand side in the green, it's nice and simple. I save about $2,500 whether I'm single or married filing jointly if I pay the owner operator a per diem pay scenario rather than just paying them straight per mile pay or however I pay them. So it's a big deal. The good news is the company also saves a good amount of money because those are not taxable wages. So again, sorry, that was a ton of tax information. I just kind of wanted to highlight from the tax reform. And um, with that, we'll kind of skip into getting into the benchmark data. I'll just leave you with we did an ebook that's about 18 pages long. You can see it on the right hand side there. And feel free to have your drivers go to our website. You can download that ebook for free. They can call our staff. Everybody here is trained on the new tax reform, and we're happy to help drivers with the different scenarios. So with that, we're going to go through the benchmark data, and just to remind everybody, on an annual basis, really every month we kind of track what owner operators are doing, and we talk about that quite a bit, and we put out information. But we do a big study at the end of every year. We take fourth quarter data and we compare all the fleets that we partner with and help them understand how their program is compared to others, and look at individual drivers. So the good news is we've done this now for almost 15 years, and the way we do it is we have very, regimented data standards where we wipe out kind of the bottom 10% of the drivers in case someone's, just joined us, or we don't have good data, for a month or something like that. And we also wipe out the very top 10% in case we've got teams that are just knocking it out of the park. So it really kind of takes the standard middle part of the owner operator population so we can look at it. And I'm going to stop right now, and I'm going to have Sean pull up a poll question so we can ask you, what you expect to do with your fleet this year as far as growth in your fleet. And you can see the prior 3 years, but please just answer this question and say, do you plan to add to your IC fleet this year? Numbers are still moving a little bit, so we'll wait just a second longer, and then I'll read you the results. All right, so you can see on the slide as we click away. Sorry, there's the poll results from the last 3 years, 2015, 16, and 17. And so I'll read you the results that we just got. So the no additions is 9%. The 0 to 5% additions is 20%. So that grew a little bit from last year, from 15 to 20%. The 5 to 10% is 35% additions, and the 11 to 20% is 26%, and the 20%, 21% or more is 11%. So I have to say, there has been almost no movement. It's almost the exact same numbers as 2017, which is really interesting because we're in the hottest freight market we've been in, and almost every fleet that we talk to wants to grow their capacity to take advantage of the great rates. And I think the results of the poll questions are what we hear from a lot of fleets. Even though we want to grow, we're having a very time difficult way finding ourselves how we're going to grow. We can't find those drivers to bring in, those owner operators to bring in to grow. So super interesting. So let's talk about the economic environment in trucking real quick. And if you've been on our webinars before, because I talk about it quite a bit, my single favorite index in trucking to figure out how we're doing is from truckstop.com, the load board. And they publish a market demand index in their newsletter every Monday. Looking at this chart, I've come over the years to believe that the red line, which is at about a 12 ratio, is the break even for our industry. When we're below 12, things are not good for truckers. When we're above 12, things are really good for truckers. And you can see over there on the right, Monday, this index was at 51.09. And, for me, that's like Dow Jones Industrial Average 50,000. It's almost impossible to believe that we have a ratio like that. What that means is for every one truck out there looking for a load on the internet through truckstop.com, there's 51 loads available. And it just tells us what we all know. There's a huge amount of freight looking to be moved, and there's not enough trucks to haul it. The good news is, that means we're at just a super robust freight environment. And I'll move to the next couple slides. I also like the DAT load board information. We study that a lot around here too. And I just looked at kind of trying to see what's happened to the market over the last year. And so these go all the way back to this time last year, March 25th, 2017, almost a year ago. The average dry van rate was $1.66. The average flatbed rate was $2.02 a mile, and the average refrigerator rate was $1.88. And let's fast forward that to kind of when the market peaked in January of this year. We fell off a little bit, kind of January, February, and we're picking up again now. But if we fast forward and look at January of this year, we were at $2.30 in the dry van market. So rates had gone up in the spot market by 67 cents or 41%. Flatbed market was up 20%, and the reefer market was up 46%. So again, when you put all that together, it just tells us what an incredible market we're in right now. And incredible markets, create change in capacity and the way people think, and what they want to do and all that kind of stuff. So those are the things we're going to talk about. One more thing I just really want to highlight is how drivers' mindset changes during the last 2 or 3 years. Those independent contractors, whether they're pioneers or hired guns that have been leased onto you as a motor carrier, they've been pretty comfortable. There hasn't been a robust amount of freight, but they've been doing all right. They've been making a reasonable amount of money, and things have been okay. And from our perspective, when we're at that gold bar that goes across this slide, which is about 42 cents a mile, um, the differential between the spot market rate and the rate that they lease onto you as a motor carrier, when that goes over that 40 cents a mile, that's a break even for us. And that means the spot market is hot, and these guys start thinking about, you know, do I really want to be leased to this fleet because I can go make more money out in the open market? And you can see kind of in 2014, we had about a 70-cent differential. And then we fell down 2015, 2016. 2017, we went back up for the whole year, average about a 60-cent differential. But if I just look at the very end of the year in December, I looked at this data and we were 79 cents above. So that meant that I could run for the average fleet for, let's say, $1.35 or $1.40, or I could go run in the spot market for close to 210, 220 a mile. And we have just a comment as we talk to thousands of drivers every day, and we hear what they're saying. We have a comment in the bottom right here, which is reflective of what a lot of owner operators are thinking. They feel like the spot market is a great place they can go make money, and they forget that being leased to the fleet has sustained them and made them successful for the last few years, and they start getting that grass is greener mentality. This slide is just a little bit different way of looking at that. You can kind of see the black line. If I'm leased onto a fleet, my average pay varies between $1.35 and $1.40 for the last many years. It's pretty stable. It's pretty consistent. It fluctuates with fuel, and it goes up once in a while. But if I'm in the spot market, the gold bar, you can see back in 2014, I went from making $1.40 to $2.20 a mile. Today, again, that's probably I'm making $1.35 running for a fleet right now. I can go in the spot market and I can make 230, 240 a mile. So really, makes a lot of these guys that have been successful with you for a long time think about, what else can I do out there to make more money? So we'll start getting into ATBS's specific data, and I always like to hold ourselves accountable based on, what we think is going to happen. Kind of early in the year, we kind of look forward and say what's going to happen. So we'll go through our predictions that we made this time last year. And it's really crazy to look back a year, but we were all still pretty uncertain about ELDs. We knew they were coming, but there were lawsuits, and there was still the potential that the ELD would not be implemented at the end of 2017. The one thing that we did know is we really believed they would be implemented at the end of the year, but we weren't quite sure how long the impact was going to be to come. So that prediction got right. The lawsuits failed, and ultimately we did implement ELDs at the end of the year. We projected net income for owner operators to be really flat last year. It was a difficult year until we got into the fourth quarter, and the market improved. So as you'll see, net income did go up a little bit for the owner operators. So we got that prediction right. Fragmented capacity will consolidate under the ELD mandate. I think our whole industry, including us, were thinking last year when this ELD comes and you've got guys that have been cheating on their logs for years, and that's a competitive advantage. When that game changes on them, they're going to have to find another way to do business, and they're going to have to probably lease onto fleets. They're going to have to do some things differently to survive. And we did see some of that for sure last year. We saw some of those Lone Rangers ultimately, winding up and going on and becoming hired guns at fleets. The last one I'm going to say we got half right. We said net rates will increase slightly through 2017, but by mid 2018 they'd be up 10%. You just saw me show some slides that said the spot market was up over 40%. So we got it right that rates were going up. I just think we underestimated because rates are going to go up more. So I'm going to talk about kind of industry benchmarks quite a bit, but we also have a lot of very specific fleet benchmarks. And for a lot of our, large partner carriers, we go out and go through this data, or we do webinars with you. And I'll just tell you, if you want to see how you specifically compare to other fleets, get a hold of your salesperson here at ATBS, and we can walk you through the specific fleet data. We have 79 total carriers in the benchmark data. We have 36 dry van, 21 reefer, 11 flatbed, and 11 specialized. And so here's the names, and a lot of these carriers are on the conference call today. Thank you for being here. But here's the names that we're getting the data from, and also as I show some comparisons, the names we anonymously rank carriers. Obviously, we don't want a carrier to know specifically how they compare against other exact carriers, so we anonymize this information as we go through the data. So we'll start off with miles. The average owner operator ran 110,000 miles last year, virtually unchanged, down 577 miles. And I want to kind of look at a longer term picture of miles. And you've seen me talk about this before, but as we've been doing this now for almost 20 years, we can kind of see trends coming our way. And the thing that's really interesting right now is miles are going to do the exact opposite of what we all think. We all know that the ELD is coming here, and so that's going to reduce miles for a lot of owner operators that didn't have ELDs. But the majority of our data comes from folks that run for fleets that are leased on, and so they've been compliant for years, and so that's not going to be a big change for them. But we expect miles to go down this year. And the reason that is because we've seen through economic cycles in the past when the industry gets good, when drivers start making more money, what they really want is more time off. They want to spend Saturday watching their kid play football, or they want to spend a day out of the truck. And so as their net income starts going up significantly, it's really counterintuitive because we're in a hot market. You'd think they'd want to be out there running and making money, but they actually drive less. And so we will see miles, and we've already started to see miles will actually go down for owner operators this year. Kind of a counterintuitive thing to think about. If we look at revenue per mile, the average leased on owner operator last year uh, did $1.35 per mile, and that was up 7 cents a mile or 5%. If you look on the very top, the two lines rather than the bar graphs, the reason that the average owner operator pay was up predominantly was because the DOE national average fuel price was up. We had, diesel go up significantly last year, and so the fuel surcharge increased. And so let me just explain these charts to you if you haven't seen them before. The black bars are month by month 2017, and the gold bars are month by month the year before. So we're comparing month by month, year over year. You get to the far right, and we look at the whole year compared to the previous year. And then the bottom right, let me just explain the independent are those lone rangers out there running under their own authority or for a really small fleet. The dry reefer and flat are folks that are leased on to one of those types of hauls, either dry reefer or flat. So you can see, the difference. If you look at flatbed on the right, you can see that their rate per mile was up 13 cents last year. And that's a big number. You'll see that reflected in their net income. Flatbed just had an incredible year last year, and the drivers did really, really well. So this would be an example. If you were one of our partner carriers, we would tell you the number that you are on here, and we could compare you and help you understand if you're high, lower, in the middle. We break things out again on dry, flatbed, reefer, and specialized. So I'm just going to give you some ranges. If you're in the dry van business, on the very low end, drivers were making $1.21 a mile. On the very high end, they were making $1.89 a mile. If you're in the flatbed business on the low end, they were making $1.48 a mile. If you're on the high end, they're making over $2, 210, 220 range. If you're in the refrigerated business on the low end, they were making $1.20 to $1.25 per mile. On the high end, they're making, $2.40 a mile. And the specialized, which, encompasses a lot of things. That's everything from tank haul to double drop deck, those kinds of things, some port businesses. So on the low end, they're making $1.36 a mile, and on the high end, they're making, $2.10 a mile. So we'll go to another poll question and talk about rate increases. So as you answer this question, what we're looking to know is, do you plan to increase the rates you pay to your owner operators this year? Numbers are still moving just a touch, so we'll give it just a minute and let you let us finish answering those questions, and then I'll tell you the results. All right, I think we got a close enough measure, so we'll go back to the slide that shows us last 2015, 2016, 2017. And I'm not surprised by this one. If we say no rate increase 0 to 2%, that was 30% of the respondents said no rate increase. So that's dropped, almost half of the folks last year, and three quarters in 2016 said no rate increase. That's dropped to 30% this year. A 0 to 2% rate increase was 32% of the respondents said that. So that's gone up a little bit. 3 to 5% rate increase we had 23% of the folks say they're going to give a 3 to 5% rate increase. So that's jumped significantly from 17% to 23%. And then more than 5% rate increase. Last year was almost nobody, 3%. This year, that's more. That's 15% of the fleet say there's going to be a greater than 5% rate increase for owner operators. And again, you're probably having a hard time capturing all these numbers. We'll put them in the slide deck when we send you out the slide deck and the recording, so that you can actually see those numbers. But thank you for the poll questions. They really can help us all gauge what's going on. So if we look at gross revenue for owner operators, it was good last year. It was almost $150,000, and again, it went up almost 5%. Remember, though, a good chunk of that was because the fuel price went up and fuel surcharges increased significantly. So I'll give you a range for the average dry van. The low guys were running $125,000 in gross revenue per year. On the high end, they're running $170,000 to $180,000 in gross revenue. And again, you're going to get these slides, and so I'm not going to go through the details of the reefer and flatbed and specialized just for the sake of time. If we look at fuel costs, the bad news is fuel costs were up last year. I already said a few times fuel went up last year. 5 cents a mile to the average driver, spending about 40 cents a mile on fuel. If we get to the details, fuel costs are important, so I'll go through each segment. On the low end in the dry van business, they spend about 31 cents a mile on fuel. On the high end, they're spending 50 cents plus per mile on fuel. In the flatbed, it's not a surprise, it's higher. On the low end, they're spending 41 cents a mile on fuel. On the high end, they're spending 61 cents a mile on fuel. In the refrigerated business, on the low end, they're spending 25 to 30 cents a mile on fuel, and on the high end, they're 60 cents a mile plus. The specialized, really pretty similar numbers. On the low end, 35 cents a mile. On the high end, 50, 52 cents a mile on fuel. So, one of the slides that's most important to me is, did the fuel surcharge actually offset enough the increased cost of fuel? And this slide helps us figure that out. So we've already said that the average revenue per mile was up 7 cents. The average cost for fuel was up 5 cents. So there was a net gain, which really tells me the bottom line, there was about a 2 cent per mile pay increase last year. And that really came at the end of the year as rates started to accelerate significantly. If you look on the far right, the increase in gross dollars was $6,700 from a revenue perspective. The fuel cost only went up $5,400. So there was a true net good of dollars of about $1,300 for the average owner operator last year. Kind of that arbitrage between revenue going up versus fuel costs going up. So that was a good thing. And again, the majority of that came in the fourth quarter of last year as rates really started to go up. For those of you that want to benchmark your fuel program, we survey 51 fleets every week. When fuel moves significantly, we get a lot of drivers that call and want to know how they're doing on their fuel surcharge. And so we like to just give them a baseline. This is almost a month old, but February 5th, the average fuel surcharge paid to owner operators was 31.4 cents per mile. So, that hasn't changed a lot. Fuel really hasn't moved much, maybe up or down a couple cents. And so that's still a pretty good benchmark today. Just some more benchmarks for by segment. Our average independent driver gets about 6.5 miles per gallon. If they're in the dry van business, they're getting 6.8 miles per gallon. Average refrigerated driver is right around 6.5. The average flatbed driver is 5.9. And you put them all together, the average owner operator is right around 6.6 miles per gallon. If we look at truck payments, they're starting to level off a little bit, which is good news. If you look historically, they've gone up significantly over the last 15 years, all the way from about $1,700 a month to currently they're right around $2,300 per month. That makes up a huge assortment of everything from brand new $150,000 trucks to guys that run 10-year-old trucks and might have payments on them. You can see for the most part, trucks go up obviously when we have an EPA mandate and those manufacturers have to increase cost because of their research and development. So again, I'll give you a little bit of a range when we look at all the fleets benchmarked against each other. If you've got a lease purchase program, this will help you figure out where your truck payments fit in. In the dry van business, on the low end, they're $1,480 per month. On the high end, we're pushing $3,000 a month for a truck payment. If we look in the flatbed business, we see payments kind of a little bit more moderate in the $2,000 range. Refrigerated business, we see truck payments higher, usually about $1,600 on the low end. We see some as high as almost $4,000 on the very high end. In the specialized business, similar, we're $2,000 to $3,000 for average truck payments. Good news about maintenance is it's really leveled off over the last 4 or 5 years. We saw some acceleration kind of going into the late 2000s as those EPA engines came in and maintenance got a lot more complicated. But we've really seen a leveling off at around 10 cents per mile on average. So that's a really good benchmark if you've got a escrow lease purchase program where you're putting that money in escrow. 10 cents is really a pretty good amount that you can set aside for these guys to maintain their trucks. So we get to the bottom line, what really matters to the owner operator, how much money did I make? And the good news is this number's been negative the last couple of years as we've been in a tough freight environment. So it went positive again. It went to $60,000, above 60,000 for the first time since 2015. We broke that $60,000 barrier for the first time coming out of 2014 and going into 2015, which was great news for the owner operator. And then we fell backwards. So it's good to be back above the $60,000 mark again. If you look at the bottom right, I touched on it a bit earlier, but the flatbed market was out of sight. Those drivers just killed it. Their net income was up, almost 8 or 9% to $70,000. The dry van guys did pretty good. Their numbers green. If you look at the independents on the reefer, especially the reefer, they really struggled last year. Things were tough for the refrigerated. What we kind of knew halfway through last year when we did some of our benchmark data was this was a good sign for the industry because when we see flatbed doing good, what that usually means is we're on our way out of the freight recession. Flatbed typically is the first one to lead us out because capital goods start moving and housing starts pick up and those kind of things get better. And so when you see flatbed do good, the rest of us are going to kind of follow that. So it was nice to see that flatbed had a great year because the rest of us are feeling that right now. If we look at the long-term trend on net income and gross dollars at the top and also per mile on the bottom, we for sure have our dips and valleys because we're in a cyclical business. But the good news is the long-term trend is positive. So I'll give you some ranges again for net income. If we look at annualized net income for owner operators, and these are fourth quarter numbers. When we benchmark fleets against each other, we do it just with fourth quarter numbers. And so these might look a little bit higher than the annual number I just showed you. From a dry van perspective, on the low end, we've got about $45,000 annualized net income. When we get up to the high end, the fleets that are, the drivers are doing really, really well, we get $80,000 plus net income. If we look at flatbed, on the low end, guys are doing $52,000 in net income, and when you get up to the higher end, they're doing 80,000 plus. In the refrigerated, on the lower end, they're doing $45,000 in net income per year. We get up to the high end, they're doing $66,000 in net income. And the specialized, people, that's hard work, and it takes more expensive equipment typically. So they make more money. So on the lower end, they're making close to 60 grand, and on the high end, they're making $90,000 plus. Cash advances for the fleets on here that do cash advances for your drivers. There are some that don't, but for us, cash advances, it's really an important thing to measure and monitor because it's a little bit like giving somebody a drug and getting them addicted to it. Once you give an owner operator too much in cash advances, they don't know how to get off of it. And from our benchmarks, we really like to see folks below 5% of gross revenue as a cash advance, and we like to see them below 10% of net income as a cash advance. That typically translates to $100 to $150 a week. And really, these owner operators should figure out how to live on their own money because they're in business for themselves. And like I say, they never appreciate when you give them the cash advance. They actually just think it's a reduction in their net income. And when they get their paycheck and they don't have a lot of money because they took a $400 advance last week, they spent that $400 advance on things like food and casinos and truck stop games and all those kinds of things. And when they get a $600 or $700 check, they don't realize they actually made $1,100 or $1,200. They only think you paid them $600 or $700 net income. So again, just a caution on advances. This is a time you can really start ratcheting advances down because they're making more money, and it's a good time to get it under control, and it'll help control kind of the bad debt as drivers leave fleets as well. So one of my last slides from a numbers perspective, I always like to compare the long-term proposition of being an owner operator. And so what this really does is compares how hard I have to work for how much money I make. And if we go back 15 years, the average driver that we did work for was running 139,000 miles. And I say this every year, but it's just almost impossible for me to believe that in this day and age. It's no wonder we have ELDs at this point, because when I think about running 139,000 miles a year, that's a crazy amount of miles, and it's dangerous. And so the average driver today is running 110,000 miles. There's been a 20% reduction in the work, and that's not saying drivers aren't working hard. They're not away from home, but they're running a lot less miles for sure. On the flip side, they've gone from making $47,000 15 years ago to $60,000 today. So in reality, what's happened is I'm working 20% less and I'm making 27% more. And I always try and keep that in perspective to help drivers understand that over the long term, we have our dips and valleys through recessions and things like that. But over the long term, the economic value proposition for an owner operator has gotten better. And I always like to put the owner operator population on top of this and kind of see how it ebbs and flows with these economic cycles. And so you can see, we had 238,000 owner operators 15 years ago. Today we have 268,000 owner operators. The really good news about that 268 number is if you look at the last big economic cycle when we went from 279,000 down to 224,000, the reason we did that is because we created a lot of false capacity. We made it way too easy to become an owner operator, and they all went out of business, during the Great Recession. We've had a freight recession really for the last 3 years, 2015, 16, and 17. And what happened to that owner operator population is it went from 265,000 to 268,000. It actually increased slightly. We didn't lose any owner operators during that difficult operating period. And so what that tells me is we've created a much more stable base of owner operators. We've raised the bar a little bit on who we're putting in the truck, and we didn't just create a bunch of false capacity. So that's a good thing. So we're going to ask you one more poll question, which we asked last year for the first time. And really, it's about um, given the current political and economic environment, are you optimistic on the IC model? So as you answer this question, you think about it, a couple of years ago when we were ending the Obama administration and there were lawsuits like crazy and the owner operator model was under attack, plus we're in a pretty crappy freight environment, it was easy to not be very optimistic. And so we started asking this question as last year as we kind of were coming out of that and things were getting a little bit better. Are you optimistic on that? So we're still got the numbers moving a little bit, but we'll give it another 15 or 20 seconds and then we'll tell you how this year compares to last year. All right, we'll close the poll and get back to the slide. And I guess, again, I'm not terribly surprised, but this is for sure the largest movement that we see in the poll. You can see last year people were optimistic, but not incredibly optimistic. Things were just starting to feel a little bit better. So I'll start at the bottom. In the not at all optimistic, last year there were 3%. This year that number is 0. So everybody on the call is optimistic about the owner operator model. So maybe that means you haven't been sued over your classification. Maybe that means your owner operators are making more money. But I'm honestly surprised that there's not a single person on the call that is not optimistic at all about the owner operator model, because there's always a skeptic in the crowd. So that's a great sign. Not very optimistic. Last year was 16%. This year is 13%. Are not very optimistic. Somewhat optimistic. Last year was 68%. This year is 52%. And very optimistic. Last year was 12%. This year is 35%. So I'd say we've had a significant upward move in sentiment. And, that goes along with the fact that we've got a new administration in the government that has really taken the pressure off of that IC versus employee risk issue. At the same time, we're in an incredibly robust freight environment. And so that's good news for all of us because there are times, I think, in the last 8 years that some of us wondered if there'd be any owner operators left in the next 10 years. So good news is we've swung the other direction, and I think things are super good for owner operators. We're all pretty optimistic about them. So just a couple of slides to wrap up with. As we think about all this stuff, what does it mean and what's going to happen to the owner operator population? We get asked that question all the time. And I'd say on the positives on the left-hand side, I have never seen this market lined up so well to create owner operator capacity. There are so many things that are in place that are really good. We have reasonably priced used trucks. The used truck market, if you're a seller of used trucks, maybe this is a little bit painful if you've got an inventory of trucks that were more expensive when you got them. But if you're a buyer of trucks, this is good news. There's a oversupply of used trucks, and there are some great used trucks out there. We've got an incredibly robust freight market. This isn't like the Great Recession when there was no access to capital and no money available to finance anything. There's a plethora of money. We get calls from lenders all the time that want to figure out how they can, get into the subprime truck lending market. We just saw the optimism. The government versus the employee attacks have greatly subsided. People feel good about that. And I talked at the beginning, the new tax incentive is incredible for owner operators to buy trucks. And so, with all those things lined up, you would think there'd be a ton of people going out to buy trucks and become owner operators. And I do believe that's going to happen. The negative is the negative we all deal with in this industry. And the bottom line is we can't find people to be truck drivers. And, when we talk about the very low unemployment rate, I think a lot of people don't take this into account. But in 2014, it was kind of the year that came and we were all excited and then it went away as quickly as it came. And really the reason it did is because we got over trucked pretty quickly. We created a bunch of capacity. And the reason we did was because we could find a lot of drivers. When we came out of the Great Recession, we were at 8% unemployment. And there were a lot of people that had been displaced from career jobs for 30 years that were willing to drive a truck for 50 grand a year. As we sit here today, we're at 4% unemployment and you virtually can go do anything in the world and make 50 grand a year. Why would I go get in a truck? And that's what a lot of people think. And so it's really hard for us to create the capacity that's going to go on to be owner operators. So I do believe there's going to be a lot of folks that go out there and take the leap and buy a good used truck or step into a lease purchase program and those kinds of things. But it's hard to fill that vacuum of company drivers coming in. So just thinking about the big picture of owner operators, and what's the future look like for them. A good friend at a large fleet sent out this tweet a couple weeks ago, and I honestly don't know Jeff Tucker, but I did a little research and found out that he owns a good sized brokerage out on the West Coast, and so he's in the business of brokering freight to owner operators. So maybe self-servingly, this tweet, was about him stating that the guys in the brokerage business are getting all the business because all these small carriers are being created. And so whether it's right or wrong, it just kind of made me think about a few things that I want to touch on. Number one, the ELD, it's a big deal. It's one of the reasons that we're in a super hot freight capacity because it's reduced the ability of drivers to run miles. But I think what a lot of us kind of assumed a year ago was as the game changed and as I no longer can run 135,000 miles a year and I got to go down to 110,000 miles, I'm either going to give it up, I'm going to quit, I'm going to go out of business, it's not going to work for me, or I'm going to maybe go lease onto a big fleet. But I'm not sure any of us predicted how incredible the rate market would be right now. And so really, if you put that in perspective, let's just say the ELD took away my ability to cheat on my miles, as simply said as that. And so it reduces my ability to generate 20% of my revenue because I run less. The fact is that if rates have gone up 30 to 40%, it more than offsets what I've reduced my ability to run miles. And so maybe I'm not as desperate as a lot of people thought I would be. And maybe I'm not going to go out of business. I'm just running less. I'm living a better lifestyle and I'm making more money. And so I don't have to make incredible change in my business. And that's probably a lot of what's going on right now when a lot of us expected these folks to have to go, find a different way to make a living. Does technology lower the barriers to entry enough to create significant lone range or owner operator capacity? So this goes back to kind of that bar where I put 42 cents a mile. I've been leased to a fleet for 10 years. Things have been good, but I hear my buddy in the truck stop telling me he's making 250 a mile and I want to go do that. That was not an easy thing to do during the last 10 or 20 years. And even in 2014, when we were in a boom freight cycle, it was not that easy. But every day, technology enables people to do things easier, to get incorporated, to get my own authority. I can do all that stuff online today. We literally get a call from a factoring company every single week that wants to partner because they think we're the access point to owner operators, which tells me that there's a ton of money out there looking to factor freight bills because there's more and more individual drivers out there running load boards. So if I'm a driver that wants to go out there and do it on my own today, it's a lot easier than it was 4 or 5 years ago. That barrier to entry has been reduced by a lot. In the current market, the reality is the guy that's leased onto a fleet, whether I'm a pioneer or a hired gun, I can leave and I can make $70,000 or $80,000 more in revenue, and it's going to cost me $30,000 or $40,000 to do that. So I can raise my net income from $60,000 to $100,000. So I'm not trying to paint a bleak picture. I'm just trying to help everybody on the line that wants to grow their own operator capacity and can't find those drivers. I'm trying to help you understand the difficulty of being in this incredibly robust market. At ATBS, we spend every day talking to drivers that are leased to carriers that have this grass is greener mentality because a lot of these guys fail when they go do that, or they're successful for 6 months or a year. And really, my last point is the market will normalize, right? We're not going to be in this insane spot market rate environment forever. And what happens when the market normalizes? And so for all of us, we need to help those drivers understand that, yeah, you can live a real short-term gain and things can be great. But when things get tough and you want to go back and lease onto that fleet, the problem is when that happens, the fleet doesn't necessarily want to lease you on because the freight as the market's gotten tough for them as well. And so they're not recruiting drivers like they are today. So it's a balancing act for a lot of drivers. Do I just stick it out long term with a fleet and know that I'm going to have a good living, or do I play the market and do I go run the spot market when it's hot? Again, interesting stuff to think about. So I'm going to wrap up with our predictions for this year. We all know that the ELD, it comes, it's delayed, it comes, it's delayed. We had one more delay at the end of the year, and real enforcement doesn't start for another couple of weeks, but finally it is here. And, so what it really boils down to is how quickly does that full enforcement that starts at the beginning of April impact the industry and the drivers? Ultimately, it probably boils down to the insurance companies that insure these guys. And when they start getting, all these records that they're not ELD compliant, do they cut off their insurance immediately? And that's when we're really going to start seeing some capacity, I think, come out of the market that's going to positively impact the market from a rate environment going forward. We believe net income is going to grow significantly. Everything's lined up. It started at the end of last year. Most fleets, most places we look and deal with, there's been some significant rate increases already passed on to drivers. If you're paying a flat rate, if it's percentage, that's already built in. So we believe that net income is going to grow a lot this year for owner operators. The grass is greener mentality is going to cause a lot of guys to question what they're doing and look at the market differently. And, so it's really important if you're a guy that runs a fleet or a gal that runs a fleet and you deal with drivers to help them understand the value proposition. They're going to go pay retail for fuel if you give them fuel discounts. They're going to lose a lot of the efficiencies. If they buy their own trailer, they're not going to have drop and hook. There's a lot of things that you can do to help them understand why you're a good place to run for them. The places that we see, gaining the most capacity this year are those that really kind of learned some good lessons back in 2014 when a lot of their owner operator capacity went away to the hot market. And they've created good choice programs. Owner operators want to decide what load they want to take in a market like this. They don't want to be told what to do, where to do it. They want to be given options of freight so that they can choose where they're going and what they're hauling for. And percentage pay programs. A lot of drivers don't understand percentage pay. They think somehow they're getting screwed in percentage pay, but the good news about a percentage pay program is it fluctuates with the market. And so, those percentage pay programs are a lot more right now than those that are trying to adjust a fixed rate pay program, in hindsight. So the last thing I'm going to leave you with is that we believe the good market's going to last through at least mid 2019. This isn't going to be a 2014 scenario where it came at the end of 2017 and by the end of this year it's over. For a lot of reasons, we believe that it's going to last well into 2019. So good times are here to stay for a little while. And I've used up more time than I expected. So I'm going to leave it there, and we're going to look at some questions. And again, if you've got questions, feel free to email them or put them in the bottom right of the screen. If we don't get to them, shoot me an email. Uh, our website's up there. You can get to me through that. So first question is, how do the categories of the drivers ATBS defined into these metrics? Are there any graphs to capture these categories? So I think the question's asking how many owner operators there are in each of those categories. And I can tell you that from just an owner operator perspective, it's about a third, a third, and a third. There's about 60,000 in the Pioneer category. There's about 60,000 in the hired gun. So that means there's about 120,000 running for fleets. And then there's about 60,000 in the Lone Ranger capacity. When you look at trailblazers, that's what makes up trucking in America. About 90% of the market is based on those Lone Rangers. I'm sorry, on those trailblazers. Another question, with many fleets struggling to maintain their current IC counts, what strategies have you seen carriers implement that have enabled them to maintain and grow their fleet size? I can tell you that almost every fleet that we deal with, barring a few that have those things in place that I talked about on the last slide, they're struggling to grow their owner operator count. And we get asked all the time, what can we do? And we're kind of in one of those environments where the guys that are good at being owner operators, they found a home, they know what they're doing, they're making money. The fleets that are growing, a lot of them have either lease purchase programs in-house or they've partnered up with a good finance company that offers a lease purchase program. And a lot of those guys, are going from company driver to lease purchase. So I tell you, I think a lot of people felt afraid of lease purchase programs over the last 8 years. I'm not a lawyer, so I'm not here to tell you they're good, bad, right, wrong. But there's a lot of good independent third-party finance companies today that will help you do a legitimate lease purchase program that will help those company drivers that want to become owner operators. That's really the only way we're seeing folks grow capacity if you're not pulling people out of the market because you've got an incredibly robust choice and percentage pay program. Um, with that, it's boy, we're at the end of the hour, so we've got a few more questions that we'll just address individually with the folks that asked them. So I just want to say thanks for attending the webinar. I appreciate you being here. I always go through a ton of information really quick, so hopefully when we send you out the PowerPoint and the recording, if you missed anything, you can get it. And like I said, if you need some specific information, just reach out to your ATBS salesperson, and we can help get you benchmark data and anything else. So have a great day. Appreciate you being on here.